Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. And if you don't know what velocity banking is, it's pretty much not saving money at all until you've paid off your debt. And that's going to involve a line of credit somewhere in the mix, right? And I don't know if anybody has ever asked you how much money you saved. I think my parents asked me like a year ago or so, and then I said, "I don't save any money." And they're like, "What? You gotta save like 3 to 6 months for emergency expenses, right?" And I'm like, no, thanks. I'm not gonna save money." Why? Because I'm doing velocity banking. And if you look at mainstream personal finance, step one is to save money. Save $1,000 in a beginner emergency fund. So saving money is seen as key to success, but we all know the drill. We all know what's the deal. We're not going to save any money when we do velocity banking. And the whole irony is that when you tell people that, okay, when you tell other people that who react negatively, they themselves are probably broke and don't have any savings. That's the whole irony. Okay. So the people who are reacting negatively to you not like declaring you're not going to save 3 to 6 months in emergency expenses or savings don't have that either. So like, why are you, why do you care? But that's just how it is, right? So before we get started, I always like to ask ChatGPT, and the way that I always now start off nowadays is, am I crazy, or is it fun? Like, is it strange how people react negatively when I tell them I don't save money at all, um, because of velocity banking, even though I don't tell them it's because of velocity banking? Okay, am I crazy or strange how people react negatively when I tell them I don't save money? What's when I tell them I don't save any money at all, and what's ironic is they are probably broke, don't have savings.
You're not crazy. You're challenging a deeply ingrained norm, and that tends to make people uncomfortable. Most people are taught that having a savings account is a universal marker of financial responsibility. When you deviate from that belief, especially without explaining the strategy behind it, like velocity banking, it can come across as reckless to those who don't understand. The irony is real, though. Many people might be living paycheck to paycheck, have no meaningful savings, or even be in debt, but they find comfort in the idea of savings, even if it's just $50 in an account. Your approach indirectly forces them to confront their own financial reality, which is unsettling. Instead of telling people what you don't do, save money, you might experiment with reframing it. For example, I put my money to work for me in ways that provide both liquidity and growth. I focus on eliminating debt quickly rather than accumulating stagnant savings. These kinds of statements might spark curiosity rather than defensiveness, and you can gauge if they're open to learning more before mentioning velocity banking. What do you think?
I get you, but I just think it's funny how people don't save money, and when you tell them that they don't, like, you don't save money and you're like intentional about it, like, freak out. Right? All right, so let's go get to it. Velocity banking, what is it? It is a debt payoff strategy using a line of credit as your main operating account. And all you got to do velocity banking is just two things. Number one is you got to have a budget. So we have a budget right here: income, expenses, savings. And you see in this case, we have negative $989. Now, here's the kicker, right? How do you save $1,000 in this situation? Can't do it, right? You got bank overdraft fees you got to pay, and you can't save $1,000 unless you actually make more money, right? And then when we do an expense breakdown, we just have to make sure that every single debt that we have is listed: one, two, three, four, five, six, seven, eight, nine, 10, 9 credit cards. two auto loans and a student loan and a mortgage. So this is the exact same situation we did last time, but just from the angle of how do we save $1,000, just like Dave Ramsey suggests us to do, which I don't know if you know mathematics, but I don't see how you can do that, right? Negative $989 in savings. We're not even positive. We're not even a penny, right? Last time we did it, or a couple times ago, we did it where we only had a penny left over, but now we're negative 900 in the hole. Okay. So this is what we're going to do. Okay. We're going to assume we have a $150,000 line of credit available. And if you've never heard of the line of credit, just think of a credit card because a credit card's a line of credit. What is a line of credit? All it is a financial tool where you can borrow money, pay it back, and then use it over and over again. That's all a line of credit is. Okay. And so what we're going to do is we're going to um, do the velocity banking side of the budget, right? And all it is, the big difference between the velocity banking side and the average American side is that we're not going to have any savings at all, none at all. But we are going to have this thing called cash flow, which we're going to increase once we move some debt into the line of credit. So if you want to show, or I'm sorry, if you want to see what I do, again, I practice what I preach. You don't have to follow me, but you see here when money comes in, it just immediately goes out, right? So after every single month, the beginning balance of my I'm sorry, my checking account is zero and it ends at zero. That's what we mean by zero savings. It's simple, right? And when I tell other people, I don't save money, what do I need to save money for? They're gonna freak out. But even ChatGPT knows all the nuances, right? Like you gotta massage it for them, right? It's a deeply culturally ingrained belief in like, oh please, I can't believe I got a massage. It's not like we're I don't know, ta shooting people, you know what I mean? We're just not saving money. That's what we're doing. We're just not saving money, okay? All right, so let's go ahead and increase that cash flow. So this is $149,000 in credit card debt, 9 credit cards, $149,000. And then guess what happens here? 149,000, right? And these credit card payments, when we just do a transfer, they essentially just go to zero. Zero, 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 right? 9 credit cards. And now we have $3,771 of cash flow. How do we get from negative 900 to $3,771? Magic? I don't know. Math? I don't know. Well, the fact that we had to open an available line of credit, and here's the thing. You're not gonna have, if it's an open and available line of credit, it's not gonna be a new line of credit, right? Because banks don't lend money to people who need it, and then when we're in this situation, the bank's gonna look at your finances like, you need money. We don't wanna deal with you, right? And that's how I have over $575,000 in lines of credit just because I always walk into the bank not needing money, and then I just get credit. Credit cards, lines of credit, personal lines of, home equity, personal. I probably need to get a business line of credit soon. Business line of credit. Okay. So, yeah. So that's basically what we're doing for today. Not a business line of credit. We'll just assume we have a home equity line of credit. Again, this is my home equity line of credit right here. Basically, I go to bank's website and I could borrow up to $280,000 with the click of a button, right? It's like Thanos. You just snap and then, instead of half of the world being gone with the click of a button, you just have lots of money dumped into your checking account if necessary. Okay. All right. So now the credit cards have been transferred. Now we got to do the final step, which is the paycheck into the line of credit. And then we take our expenses out of line of credit. And then after every single month, our cash flow is going to be used to reduce the balance of the debt by $3,771. It's really simple. Okay. So now let's go ahead and do this. And then we're going to take the previous one's balance plus the previous one's interest minus our cash flow. And then we're going to take the average daily balance, multiply it by the interest rate 0.08, and then divide by 12, right? So 0 at 0.08 is like 8%. and then divide by 12 because it's monthly. The interest is calculated monthly. And let's see how long it takes to pay off all of this. You just do Control C, Control V. All you're just gonna do is copy the formulas, and then once it turns red, it's like, wablam, look at that. In 46 months, it's over. The credit card debt is gone. 46 months. Hold on. 46 months. 46 months, and how much debt did we pay off? 149,000. Okay. And then now was auto loan. Okay, auto loan in 46 months. We got to figure out how much is the auto loan, right? And so if we type in 46 into this loan calculator right here, we see that most of it has been paid off by that time, right? So again, auto loan's only 5 years. I think was 5 years, like 52 months. So we don't have that much balance in the loan, but we could just move these into a line of credit and immediately increase our cash flow. So let's go ahead and do that. So this is going to be G2 plus G3. So 22 grand. Let's move this 22 grand into the line of credit right here. Plus 22746.25. And then guess what? These two payments, the two auto loans go to zero, right? And then now our cash flow is $5,459.09. Wow, that was easy. Okay. All right. Copy and paste. Let's just do this. And then instead of 3,771, 5459.09. And let's see how long it takes for us to pay those two auto loans off in 51 months. 51 months. Okay. So now let's go back here. And then 51 months and 149 plus 42 plus 45, 236K. Okay. So 55,000. That's the student loan. So after 51 months, what's the balance of the student loan and the mortgage, right? So what we do is do 0, 0, and then do 51 here, 51 there. And then we see we have 35 grand in the student loan. So you see this number here, the cash flow index. Basically, if you know how it works, anything below 50, that's the prime candidate for paying off to increase your cash flow. And anything above 50, it's considered, I don't know if it's considered inefficient, but definitely above 100 is considered inefficient. So what does that mean? If this number is too big, it means that if you pay it off or focus on paying this off first, you don't get that much bang for your buck in terms of payment, right? So it's 35 grand for $600 versus 199 grand for $927. So let's move this 35 grand into the line of credit, although I'm probably wouldn't actually do this in real life just because, again, you don't get that much bang for your buck from moving the student loan there. So, but what I know is that when you do something called chunking, it's resistant to the interest rate, 35621.92. Okay, so let's just add that. And then now we have the student loan 0 and our cash flow is 6 grand. So 6 grand right here. 6072.47. Okay. And then now by 57 months we're attacking the mortgage, right? So let's just go back here, 57 months. Okay. And then 236 plus 55, 236 plus 55, right? So that's 291 months. Okay. So give me one moment. So 291K. Okay. And then now let's go back to here, 57 months. And I just want to quickly show something. So in 57 months, right? 57 months, how much did we pay in the principal? 24K. Now let's move 24K into the line of credit and see how quickly it pays off. Okay, 24K. So we just go here, plus 24,000, right? 4 months. 1, 2, 3, 4. See how easy that was? 4 months. And we're just going to repeat the same process over and over again. And luckily, we have a calculator to determine the debt payoff when we use this method to make it easiest for us to pay off the debt. So give me one moment to open it up. All right, so we got the velocity banking calculator up and running. It's just plug and play. And then this here is the chunk amount. So we don't need to do huge chunks, just one similar to our paycheck should be fine. But if we did 24,000 chunks, so this goes up a little bit. So you don't want to do big chunks, you want to do small chunks into the line of credit. And if we move this into the line of credit, 21 grand, you see how it multiplies the interest by 3 times. So again, even though you save money, you're better off not moving the entire thing into the line of credit. And the reason is that there's not enough cash flow to offset the interest. Okay. Okay. All right. So 2.5 years, 2.5 years. And then scroll up, and all we gotta do is do this, which is 57 divided by 12 plus 2.5. And then 7.25 years, we are debt free. That's it. That's it. See how easy that was? And we didn't save any money until we paid off all of our debt, right? 7,000, and then 14,000. And then you can tell your friends, hey, I saved money now. But it's not just 3 to 6 months of expenses, or it's not for that. It's just because I have nowhere to put my money, because, or at least I have no debt, right? You can say that I have no debt, so I save money. But when you tell people that you're just not going to save money, they react negatively, because we're challenging a deeply ingrained norm, deeply ingrained. Okay. All right. Well, that's it for today. Just another Velocity Banking review. Have a great day, everybody. This is Korean Atlanta Mentorship.